All right. I guess I can kick it off since we don't have a moderator and we're here for a friendly banter on what everyone here is most excited to talk about, the impending supply shock that will come from the launch of our treasury companies. Maybe just a quick intro. I'm Jeff Park. I'm the CIO of ProCap. We're one of the Bitcoin Treasury companies coming online in the near future. Prior to that, I was at Bitwise, the head of Alpha Strategies, and I'm excited to be here.
Matt Cole, Chairman and CEO of Strive.
Alexandre Laizet, board member and director of Bitcoin Strategy at Capital B, Europe's first and largest Bitcoin treasury company. It's great to be with you guys and talk about the supply shock that is incoming and that we are also contributing to with Bitcoin. What do you want to first start with, Jeff?
Yeah, maybe I can kick it off by framing the conversation of what it means to really thinking about scarcity in the face of a supply shock. And I think to really understand scarcity, we have to also take a moment to understand a close cousin, which is liquidity on the other side. And liquidity actually can mean a lot of different things to different people as well. And there are two types of liquidity that I think exist that people can sometimes conflate, and it's important to distinguish these in the context of what scarcity can mean for Bitcoin that I think is additive to the conversation. So when people talk about liquidity, there's market liquidity, which is literally driven by volume and whether you can move big sizes with minimal bid offer, price impact, and slippage, and that is a kind of liquidity driven by volume. But there's actually another definition of liquidity, and this is the slightly more sinister version of liquidity, which I call funding liquidity. And it is the liquidity in which your asset can be pledged to generate liquidity for other things to then sit on top of it. And that's the collateral haircuts, that's kind of the repo operations. This kind of liquidity is also another contribution to our financial system. And so scarcity can also exist, I think, in both of those dimensions. There's liquidity that comes from market, the way scarcity comes in the market factors as well from a trading perspective. And there's scarcity that speaks to its sovereign value for which it actually can't be rehypothecated or margined away into, financializing the denominator of that particular asset. And so I think the beautiful thing about Bitcoin is, and the Bitcoin Treasury company operations that we're all part of promoting the awesome possibilities here, is that for the first time, you can leverage the inherent scarcity of Bitcoin as an asset for a funding definition, but unlock the market-based liquidity that can come with treasury companies in which you can actually financialize a whole slew of risk preferences on the back of that asset and create a different kind of liquidity. And that, I think, is kind of the unique opportunity that we're all exploring the white space for and how to perfect that intersection. And if you really think about it hard enough, liquidity and scarcity at the intersection of it is credit. And credit has to be based on an asset that is liquid enough so people can actually think about haircuts, but it also has to be valuable because that's ultimately what investors are looking to think of as a hard asset to which they're lending on. And I think that nexus is the interesting thing that Bitcoin Treasury companies are unlocking here.
Yeah, one of the ways that I frame this, which is similar, and I agree with everything you said, is looking at when the Federal Reserve was doing QE, and there was a lot of institutional analysis of stock and flow. And so if you think about stock, it's just where, in the Bitcoin terms, where do the Bitcoins sit, and how permanent are they sitting wherever they're sitting? And the flow is the dynamics of new Bitcoin into the market, and then the demand to pull Bitcoin into a stock pile somewhere. And so if you think about the early days of Bitcoin, you had very high inflation rates through mining of new Bitcoin. Every time we have a halvening cycle, that goes down more and more. And my view is that that has gone down to a point where I don't think that halvening cycles will drive bull runs or bear runs, but that I'm of the viewpoint of most likely we're in this more super cycle mindset, and that's based on the stock and flow argument. So where are the large stocks and where are they growing? Well, in the past, it was really hard to buy Bitcoin in a retirement account. Now you're starting to see access through Bitcoin ETFs, that people can buy them in their 401k, in their IRA much easier. I think in the early days, you had to go start a self-directed IRA and open up a LLC and a bank account and do all these crazy things just to be able to buy Bitcoin. Now it's super easy, and likely you'll be able to just buy Bitcoin on Schwab, and probably in the pretty near future. So that helps flow into longer-term capital, not just a brokerage account, but a retirement account. Then you look at Bitcoin Treasury companies that are buying Bitcoin as permanent capital. So how many times has Saylor said, never sell your Bitcoin, or I'm not selling my Bitcoin, right? This is a flow into a stockpile that will not move. As smaller governments, but ultimately bigger governments, the United States has a digital Bitcoin stockpile. If they were to actually purchase, that would be likely to be permanent Bitcoin buyerships. So these stockpiles are growing, which means that there's less Bitcoin available. And then on the flow side, we can get into that, but the short version is that when you add the ETF flow, the Bitcoin Treasury flow, it's substantially greater than the mining flow. And I think that it has a more longer-term nature to it than when it's Bitcoiners on an individual basis trading in brokerage accounts and personal accounts on Coinbase or whatever. And so I think those dynamics lead to supply shock dynamics over the coming years.
Three observations as well on this. The first one would be that, as Pierre Rochard says, there are not enough Bitcoin treasury companies. You could think that there are a lot, and you could ask yourself, is that not too much, and is that not too much offer in the market compared with the demand? And the reason of all of these companies coming up is that you have Bitcoin be recognized at institutional scale, at nation-state level, as the next store of value, directly or indirectly, because at the end of the day, a nation-state needs to continue devalue slowly the currency to make the debt slower. And so you have institutions adopting Bitcoin at scale, and you have Bitcoin treasury companies, of course, taking advantage of this, and you will have a big Bitcoin treasury company in each capital market, and you have various winners in each capital market as well. And the second observation for this is that Bitcoin, as Pierre says, is going to be the most capital-intensive industry. And for this, companies and investors are not yet ready, because capital pools are just starting to get allocated to Bitcoin treasury companies. And what you have seen is that Bitcoin treasury companies start to be the variable of the volatility before Bitcoin moves. And so even when investors get out of Bitcoin treasury companies, many times they come back to Bitcoin itself. And then when they leave Bitcoin, they go to the Bitcoin treasury company. And so what you get is more companies adopting Bitcoin, and what you get is less selling pressure for Bitcoin. The selling pressure is going into the volatility of the stocks of the Bitcoin treasury companies. And then what you have is an observation, which is that you can indeed still live without a Bitcoin standard. I mean, in France, you can have, I'm from France, in France you can live without speaking English. But if you don't speak English, you are poor, you are weaker in the economic area. And so it's the same with Bitcoin. You can, as an institution, not have it, not have exposure to it, but over time, the institutions that are allocated to Bitcoin and to Bitcoin treasury companies are simply outperforming the market. And so when we speak about the supply shock potential, what we have is today varied capital markets that are adapting to this new asset that is taking over new capital pools. And over time, those treasury companies are going to become the largest potential capitalization in the market. You are already seeing it with Strategy in the US, very high liquidity, very high market capitalization growth, and a prospect of becoming a multi-trillion-dollar company. And so when you have this type of growth of a company in a capital market, then you have everyone that is within the indices exposure that is in some way, shape, or form allocated to Bitcoin. And in this sense, Bitcoin, for Bitcoiners, yes, Bitcoin is the hurdle rate, but then the Bitcoin Treasury company becomes the hurdle rate as well. And when you have a strategy outperforming by 2x, 3x, then the hurdle rate becomes, in fact, the Bitcoin Treasury company. And even as a Bitcoiner, if you live on a Bitcoin standard, then if you are not exposed in some way to Bitcoin Treasury companies, then you might end up with less purchasing power over time because you have then all over Bitcoiners that are starting to get exposure to Bitcoin Treasury companies. And so what I would say is happening is that you have a lot of liquidity events and a lot of volatility in Bitcoin Treasury company markets, but that overall is also enabling the company to have more liquidity to issue more instruments to acquire more Bitcoin. And so in this sense, we are all contributing towards what is the transfer of more fiat into Bitcoin, but at the same time, fiat printing is infinite. And so you can have a more valuation in terms of Bitcoin and Bitcoin Treasury companies, but the number of fiat that is being issued is also keeps increasing. And so yes, there is a form of supply shock happening, but at the same time, there will be still more fiat in the world to be allocated to Bitcoin Treasury companies.
Yeah, I agree. I think also when people coined the term supply shock, the framework really anchors to how we've observed historically in traditional markets with commodities in particular. And so that's the other thing that I always think about as well as to like how it would relate to its transferability to understanding Bitcoin's supply shock, right? Because they're different. Bitcoin's digital, right? Physical commodities actually exist in the real world, so the constraints are very different. So, but nonetheless, there's lessons and parallels to study for which we can appreciate. So for example, the way we see supply shocks happen in the commodities market has three variables, right? It's usually reflected in the storage cost somehow. It's usually reflected in the transportation costs, or it's usually otherwise reflected in the financing cost of additional kind of leverage or borrowings you may need to facilitate the credit in trade finance. Bitcoin's different because actually it doesn't have many of those things, right? There isn't really like a transport cost to Bitcoin. You can't really like put a price on that. Storage cost, same thing. It doesn't really physically take up any space, so you're not going to see demand and supply affect that particular curve. So, you know, what have investors been really focusing on? Well, historically, investors look at on-chain exchanges to see how much supply is on there, right? And that can be a little bit misleading too, because, you know, I hear often people saying like, oh my gosh, Coinbase is going to run out of coins, and so it's going to go rip through the moon as there's no supply. But that's actually like crazy, right? Like, of course there's supply. And so historically what that signaled was that there were no willing like sellers coming online to actually, you know, sell their coins, right? Because usually what you saw with uptick of the supply was, well, the ancient whales are coming to actually offload supply. That's the only reason they would bring it to an exchange. Hence, there's going to be a selling supply rather than actually saying anything about a buying pressure. So I think what that shows you is that where the supply shock really will come from in crypto will most likely still be a demand-driven shock. And so I wanted to kind of make that point there in the ways that we have to rethink about what supply shocks can mean in crypto, relatively speaking. And from that perspective, there was a really interesting research that was put up by Fidelity recently. It claimed to study through two types of holders. One are institutions like Bitcoin Treasury companies that own more than 1,000 Bitcoins. We know that's locked up Bitcoin, so that's definitely long-term holders. And then there's the other cohort, which are those who have held Bitcoin for 7 years or longer and actually haven't really moved them along. Aggregating those two groups, the report predicts that by the end of this year, 28% of Bitcoin will be allocated to that group. And by the end of 2032, that group is actually going to take over closer to 45%. I mean, that's a pretty big number. And I think, to Matt's point, we're now at a point where the emissions schedule in itself is not going to be the source of the market adding supply. 95% of Bitcoin have in mind, but it's really going to come from wrappers and vehicles like Bitcoin Treasury companies that actually take the supply offline to engage in those fiat-based kind of opportunities that are possible on the other end to provide access, synthetically speaking. And so there's just going to be different ways to monitor where the leverage sits in the system, but I think it's worth noting that the supply shock in the ways past versus the way that it's going to go in the future, it's just going to look totally different. So whatever we ever knew about Glassnode and all those things that we're tracking, it's just less relevant in the construct of the new wrappers that have come online. Even the ETFs. The ETFs are, customer funds, right? What matters is what are the kinds of people that buy these ETFs? And to that point, like having it in a Roth or IRA account signals a new kind of investor that can come in that isn't like the Millennium hedge funds of the world trading the basis, right? And so, ETFs are ultimately client assets. If people sell the ETF, that Bitcoin is coming back online. It will come to the exchange. So I think the breakthroughs we're going to see is that there's going to be just more meaningfully long-term holder wrappers that are out there that continue to suck up most of the supply in that framework.
Maybe one more just thought on the point on the commodity supply shock part, where when there's demand that flows into commodities, you can see commodity prices go up very quickly, very rapidly. The difference with traditional commodities versus Bitcoin is that you can't get new supply from a business, right? And we've never seen that before. But with traditional commodities, it's not like the price goes up and the new supply can go on the next day or the next month. There is a cycle, right? You have to get new mining rigs going, hire people, and then that eventually brings new supply on over a period of time from maybe it's 6 months to a few years. With Bitcoin, you can't. And so I think that the difference that what I think we're going to have to see play out is that it could create a longer super cycle because the lack of supply being able to come from operations is just not there. And so that kind of gets into the more positively convex nature to Bitcoin prices to the upside that I think you could see in an environment that we're talking about with ETFs and Bitcoin Treasury companies. And the bottom line is no one knows how it's going to play out, but you can see how people could get very bullish, including myself, of where Bitcoin could come and go in the coming years.
I've had over the last months 80 plus conversations with financial institutions across the board, and a lot of the questions was, what about the business model of a Bitcoin treasury company in about 3 to 5 years and so on. And I think what is happening with Bitcoin treasury companies and what we can see from our shareholder base is a supply shock that is starting to arrive on top of another supply shock. Because what we have as shareholders is a mix of short-term investors that are in for the short trade and monetize short-term volatility, but over time, when you get a massive run-up, we've done plus 3,000% and then minus 50%, and you can see a formation of long-term shareholders over time. It's like accelerated bull and bear market runs in Bitcoin treasury companies. And what you can see is an increase on at least the communities on X, on Discord that we have at Capital B, an increase of the understanding of what is Bitcoin, of what are Bitcoin treasury companies, and what is a pure play Bitcoin treasury company that is completely focused on maximizing Bitcoin per share. Our objective is to reach 1% of the total BTC supply over 8 years, and we have shareholders that have said, I am here for 10 years, I am not touching the stock, I am hodling the stock, and I like the fact that the company has pure clarity, that has pure focus, that is completely focused every day on maximizing BTC yield, the increase of sats per share. We were talking about a super cycle. Well, Bitcoin treasury companies that are completely focused on maximizing Bitcoin per share at each capital operation already have a form of super cycle, and this super cycle is the increase of their sats per share over time. And so in some way the price in fiat doesn't matter other than being able to share sales at an existing premium or at an embedded premium to of course, the stock price with the credit instruments. And so there is a double arbitrage that is happening, is both the Bitcoin Treasury company that is, of course, leveraging the elasticity of capital markets to acquire the most inelastic on-off, which is Bitcoin. And on top of that, you have investors that are leveraging the elasticity of the Bitcoin Treasury company to increase their compounded sats per share over time so that they have a leverage into the potential of a supply shock on Bitcoin. Because what happens if there is a supply shock on Bitcoin at some point in the future and that people lose confidence into the fiat currency of their own country? Well, you have Bitcoin that goes up in the fiat currency of your choice at a certain moment, and you have, of course, then the stock price of the company that is potentially going up in a levered way. And what is the company going to do with the stock price going up? It is going to buy more Bitcoin and increase the sats per share. And so in that way, Bitcoin treasury companies are Bitcoin accumulation machines that have already, in a matter of 5 years, but even accelerated over the last 6 months, suppressed 1 million whole coiner opportunity. So you have 1 million Bitcoin that have completely disappeared from the supply because they have been absorbed by Bitcoin treasury companies, and those companies are held by millions and tens of millions of shareholders over the world. And so you could call that a speculative attack. You could also call that the most rational thing to do when you know that there is an unlimited supply of fiat and a finite supply of Bitcoin.
We have time for one question. Anybody? Anybody? Bueller?
Thank you. So you guys basically addressed both sides of the question I had, but I want to take it one step further. So the world's never seen an absolutely scarce fungible asset before, so we have a hard time envisioning what supply shocks can look like, and we've never seen an asset, as you guys talked about, where to some extent there's not elasticity around the price. There are certain types of demand buyers of Bitcoin, governments, companies that will keep buying regardless of the price to some extent. So I'm curious, given that all of us in here are in the treasury space, if any of you guys have done the next level research to say, if things continue the way they are, how long into the future can treasury companies stack in big volume? Like we're seeing 1,000+ purchases in one go. We've done research at Arcadia Bitcoin, and we think it's 4 or 5 years, and it's going to be, after that, it's going to be smaller stacking continuously into the future because of the supply-demand dynamics of Bitcoin.
Yeah, so 2 comments. One, not your models, but the models are broken, right? And the models are broken because we've never seen an asset like this. And so to be humble, like, we don't know. But we think that the digital gold rush is a 10 to 15 year phenomenon, and over time it's going to be harder and harder to stack sats for these companies, and so that's why we do think it is early that people that are able to get going are able to build pretty large stacks of Bitcoin. But I think the focus, and you see this focus across this room, is stack sats. There's a million ways you can monetize a massive balance sheet over time, but that exercise is fruitless right now during the digital gold rush era because, to your point, in 5 years, you won't be able to get anything close to what you can get today.
Yeah, I agree with this. And, I think at some level, anyone can go out and buy as much Bitcoin as they want later, 10, 20 years. It's just the opportunity cost will look different, right? So I think at some point what we're seeing is the monetization of that volatility for the opportunity set today being the advantage for which we're not going to have 20 years later as a company then. Which brings back to the original point of like scarcity, right? Because scarcity in itself is going to create volatility by definition, but the thing is, volatility also can be a catch-all phrase for things to mean bad things, but I would go so far as to say there's things that can be good volatility and things that are bad volatility, right? Earlier this morning, I saw Gary Gensler on CNBC commenting on the rules making around quarterly earnings being moved to semi-annual and whether that's going to be good or bad. And he said, Well, it's bad for investors and bad for investor protection because it's going to create more volatility. And I think the point that sometimes people miss is volatility that is created by having symmetric information that is pricing the market very quickly is very good. That's actually good to have volatility where there's liquidity behind it. What's bad is volatility or lack thereof because there's no price discovery. When people say private credit is an amazing opportunity because there's no volatility, that should be frowned upon as something beyond it in itself being a virtue. So I think the other part of this journey that we're all on with Bitcoin Treasury companies now versus 15 years later is the knowing embrace of volatility and the kind of good volatility that I think is ultimately what Bitcoin represents because of the efficient liquidity of the market structure, which is really signaling information alpha. And it's not driven by other kinds of manipulations that otherwise is not available in open source way that all of us can observe.
Matt Cole, Jeff Park, Alexandre Laizet, thank you very much.
Bitcoin custody is evolving, and OnRamp leads this change with multi-institution custody, eliminating single points of failure. Instead of one institution or complex private keys, OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault backed by 3 independent, institutional-grade custodians. No single custodian can move funds by themselves, providing an unprecedented level of security that traditional custody solutions simply can't match. Protected by a $100 million Lloyd's of London insurance policy, all transactions are fully auditable on-chain, never rehypothecated, and executed only at your explicit direction. This means complete transparency and control over your assets at all times. Beyond custody, OnRamp delivers comprehensive Bitcoin financial services, including lending, trading, inheritance planning, IRAs, and more. OnRamp functions as your private banking partner, coordinating key holder activity, removing technical burdens, and providing a personalized, trust-minimized experience tailored to your specific wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps secure generational wealth with unmatched security and peace of mind. Visit onrampbitcoin.com today to learn more, sign up, or book a free consultation with their team of Bitcoin custody experts. Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. Join us at The Win in Las Vegas, February 23rd through the 26th, 2026 for Bitcoin for Corporations. Use code KOTZ when you grab your tickets at strategy.com, and we'll see you there. This episode is brought to you by Arch Lending, the premier provider of crypto-backed loans designed for both individual and institutional investors. At Arch, your digital assets work for you without selling them. Arch offers flexible loan options tailored to your needs. Backed by industry leaders like Morgan Creek Digital, Castle Island Ventures, and Galaxy Ventures, Arch Lending is setting a new standard in crypto-backed lending. Are you ready to unlock the potential of your crypto assets? Visit archlending.com to learn more and configure your loan today. Are you looking for comprehensive analytics on corporate Bitcoin adoption? Strategy Tracker delivers real-time insights into how companies are executing their Bitcoin strategies completely free. Monitor NAV premiums, cost basis performance, and track how corporate Bitcoin treasuries perform against the market. Upgrade to Premium for just $3.99 a month and unlock exclusive benefits like detailed market rankings, real-time trading volume analysis, and advanced performance metrics for corporations embracing Bitcoin. Apply code KOTZ at checkout for 100% off your first month of premium. Strategy Tracker is your essential tool for measuring the effectiveness of corporate Bitcoin strategies. Visit strategytracker.com and gain the analytical edge in understanding the Bitcoin Treasury phenomenon.